Every major economic theory explained, a deep analysis of how economic ideas shape power, wealth, and society. Why economic theories matter more than ever. Economics is not just an academic discipline, it is a belief system that quietly governs how societies organize work, distribute wealth, define success, and decide who wins and who loses. Every tax you pay, every interest rate change, every housing boom or crash, every bailout or austerity program traces its roots back to an economic theory, often one most people have never heard of. The idea behind every major economic theory explained is deceptively simple. Explain how different schools of economic thought interpret the world. But the deeper truth is more unsettling. These theories do not merely describe reality, they shape it. Governments choose which theory to believe in. Central banks enforce them. Corporations exploit them. Ordinary people live with the consequences. In today's world, marked by soaring inequality, unaffordable housing, mounting debt, currency debasement, financial bubbles, and growing distrust in institutions, understanding economic theory is no longer optional. It is a survival skill. This analysis goes beyond definitions. It asks harder questions. Why do some theories dominate while others are ignored? Who benefits when a theory becomes policy? Why do economic solutions often fail the very people they claim to help? And most importantly, are we using outdated ideas to solve modern problems? To answer these questions, we must walk through the evolution of economic thought, starting with the classical era and ending with the fragmented, unstable system we inhabit today. Classical economics: order, markets, and the illusion of balance. Classical economics emerged in the late 18th and early 19th centuries during the rise of industrial capitalism. At its core was a powerful and comforting idea: markets are self-correcting. Core assumptions. Classical economics rests on several foundational beliefs. Individuals act rationally in pursuit of self-interest. Competition ensures efficiency. Prices reflect true value. Supply and demand naturally balance. Government intervention distorts markets. In this worldview, unemployment, shortages, and crises are temporary. If wages fall, jobs return. If prices rise, demand falls. The system corrects itself, eventually. Strengths. Classical economics was revolutionary for its time. It challenged monarchies, mercantilism, and feudal privilege. It legitimized entrepreneurship, trade, and innovation. It helped fuel industrial expansion and global commerce. The fatal flaw. The problem is not that classical economics is wrong, it's that it is incomplete. It assumes perfect information, equal bargaining power, rational behavior, moral neutrality of markets. In reality, workers cannot endlessly cut wages and survive. Corporations gain monopolistic power. Financial markets behave irrationally. Human beings do not act like equations. Classical economics works best in textbooks. In the real world, it ignores power imbalances, financial speculation, and human psychology. Marxist economics: class, conflict, and the anatomy of exploitation. Where classical economics saw harmony, Marxist economics saw conflict. Core idea. At the heart of Marxist theory is a single premise: capitalism is built on exploitation. Workers sell labor. Capitalists own production. Profit is extracted from unpaid labor. Inequality is not a flaw, it is the system. Key concepts: class struggle between labor and capital, surplus value as the source of profit, concentration of wealth and power, cyclical crises inherent to capitalism. Marx argued that capitalism would eventually collapse under its own contradictions: overproduction, falling profit rates, worker alienation, and social unrest. What Marx got right: wealth concentrates over time. Crises are recurring, not accidental. Workers have less power than capital. Economic systems shape politics and culture. Modern data on inequality, housing, wages, and corporate consolidation strongly support many of these observations. Where it failed: Marx underestimated the adaptability of capitalism, the role of technology, the failures of centralized planning, human incentives. Marxist systems often replaced private exploitation with state-controlled inefficiency, corruption, and authoritarianism. Keynesian economics: managing demand in an unstable world. The Great Depression shattered classical assumptions. Markets did not self-correct. Mass unemployment persisted. Entire economies collapsed. Keynesian economics emerged as a response. Core idea: the economy can get stuck in long-term dysfunction. Government must intervene to stabilize demand. Policy tools: government spending during downturns, deficit financing, monetary easing. Counter-cyclical fiscal policy. Keynes argued that during crises, waiting for markets to fix themselves causes unnecessary suffering. Successes: post-July-Weinstein's economic stability, expansion of the middle class, infrastructure development, lower unemployment. For decades, Keynesian policies underpinned Western prosperity. The long-term cost: the problem is what happens after the crisis. Governments keep spending during good times, normalize debt, inflate asset prices, create moral hazard. Over time, stimulus becomes addiction, debt becomes permanent, central banks become trapped. Monetarism, inflation, control, and the power of money. Monetarism emerged as a backlash against Keynesian excess. Core belief: inflation is always a monetary phenomenon. Control the money supply, control the economy. Key policies: interest rate manipulation, tight control of money growth, central bank independence. Monetarism restored credibility to currencies in the 1970s and 1980s. Hidden consequences: wage suppression, financialization of the economy, asset bubbles, wealth inequality. By prioritizing price stability over employment, monetarism shifted power from labor to capital and from governments to central banks. Neoliberalism, markets above all else. Neoliberalism is not just an economic theory, it is a political ideology disguised as economics. Core principles: privatization, deregulation, free capital movement, weak labor protections, globalized markets. What it promised: efficiency, growth, innovation, freedom. What it delivered: deindustrialization, outsourcing, precarious work, financial dominance, hollowed-out states. Neoliberalism treats society as a marketplace and citizens as economic units. Everything becomes commodified: housing, education, healthcare, even attention. Behavioral economics, the myth of rational humans. Behavioral economics shattered one of the most dangerous assumptions in traditional economics: rationality. Core insight: humans are emotional, biased, short-sighted, and irrational, especially with money. Implications: markets misprice risk. Bubbles are predictable. Policy must account for psychology. Behavioral economics explains why people take on debt they can't repay, why investors panic, why bubbles inflate despite warnings. Yet, despite its insights, policy still assumes rational actors because admitting irrationality undermines the entire financial system. Modern monetary theory: money, power, and sovereignty. Modern monetary theory, MMT, challenges one of the most sacred beliefs in economics, that governments must balance the books. Core claim: a sovereign government that issues its own currency cannot run out of money. The real constraint is inflation, not debt. Why it matters: MMT reframes government spending, public investment, social programs, deficits, the risk. MMT works in theory, but in practice, political discipline fails. Inflation erodes trust. Currency credibility collapses. Used responsibly, MMT could transform societies. Used recklessly, it destroys them. Austrian economics: sound money and the fear of central control. Austrian economics distrusts government and central banks almost entirely. Core beliefs: free markets are superior. Money should be sound and scarce. Central banks create cycles. Intervention causes distortion. This school predicts asset bubbles, boom-bust cycles, currency debasement, modern relevance. Austrian ideas underpin gold advocacy, Bitcoin philosophy, anti-central bank movements. Its weakness lies in underestimating social costs and instability during downturns. Where we are now: a system without a theory. Today's global economy is not guided by one theory, but by contradiction. Keynesian stimulus in crises. Monetarist inflation control in theory, neoliberal markets in structure, MMT logic in practice, behavioral chaos everywhere. The result: permanent emergency policy, asset inflation, debt saturation, declining trust. We are living in an economic system that no longer understands itself. Conclusion: understanding economics is understanding power. Economic theories are not neutral. They decide who owns assets, who carries debt, who gets rescued, who gets blamed. The greatest danger today is not choosing the wrong economic theory. It is believing one theory fits all times, all people, and all crises. The future will not belong to ideologues. It will belong to those who understand systems, incentives, history, and human behavior. Economics, at its core, is not about money. It is about power, scarcity, and choice. And the choices we make next will define the next century. Stay aware. Stay awake. This is Felix. See you next time. Don't forget to like and subscribe.